Good morning. This is Dave Toth with an RJO MRT technical webcast update on the S&P E-mini, the Mini Russell 2000, and the 10-year T-note markets for Tuesday, March 15th. Starting off here with a daily chart of the S&P E-mini, you can see overnight's sharp break and continuation of not only the past week's impulsive sell-off attempt, but the reaffirmation of a much broader peaking and reversal threat that we've been discussing for a few weeks now. By virtue of this continuation, this sharp impulsive continuation, we continue to advise a cautiously bearish policy for the foreseeable future, with strength, looking at the 4-hourly chart now, strength minimally above the 1303 high from Friday, the latest and tightest corrective high. This market needs to recover above to confirm the bullish divergence in momentum necessary to arrest this sell-off and define a more objective low and support. With respect to downside targets, looking here at a weekly log scale chart, you can see the former major resistance from last year, both in April and in November, in the 1217 to 1224 range. If there's an area that we should look to as a support candidate, it would be this 1217 to 1224 area. If this sell-off over the past month or so is to prove just a intermediate term correction lower, if the market can clearly break below this 120 the 1200 area, a much larger degree reversal lower will be exposed. And in that vein, regardless of what levels we look at as support candidates, the absolute fact of the matter, and the most important technical fact of the matter, is that the trend is clearly down at this point, and the only thing that's going to stop lower prices is higher prices in the form of a confirmed bullish divergence in momentum. And currently, that the recent corrective high this market's obligated to recover above is that 1304 level from Friday. That's not to say that the market, as we approach the 1217 to 1224 area, that the market won't provide another bullish divergence in momentum potential, but we absolutely need the market to confirm such a momentum failure to define a more reliable low and support from which a bullish policy, a resumed bullish policy, can be more objectively based. In lieu of a simple confirmed bullish divergence, even in short-term momentum, further and possibly accelerated losses remain in the near future. Moving to the Mini Russell 2000 market, and similarly you can see overnight's continuation of this broader peaking and reversal threat. The market has really now broken solidly below that 78.93 initial counter trend low from February 24th and exposes a much larger degree correction or reversal lower. From an intraday perspective, you can see former support now considered new resistance in the 78.93 to 78.85 area, with a recovery above Friday's 80.70 high, the minimum strength required to confirm a bullish divergence and momentum needed to arrest this sell-off and expose perhaps a resumption of the secular bull trend. In lieu of such proven strength, further and possibly accelerated losses are remain expected, with looking at a very long-term daily chart dating back to the July 6th low at 58.96, where we've arguably completed a 5-wave Elliott wave sequence to that February 18th high at 83.43. We cannot underestimate the extent to which this market might now be vulnerable to further and possibly accelerated losses, where even a minimum 38.2% retrace of that July through February rally doesn't cut across until the 73.07 area. From a weekly log scale, weekly close only chart perspective, you can see that former resistance from last April, a considerable high in resistance in the 74.60 area. We would look at that area as a solid support candidate, but like with all clear trends, and clearly on a short to intermediate term scale, the trend is clearly down. The only technical factor capable of defining a more objective low and support is a confirmed bullish divergence in momentum, and specifically the market's failure to sustain losses below the most recent corrective high. And currently that most recent corrective high of merit is at 80.70. That's not to say the market won't provide a similar bullish divergence potential setup from some lower level, perhaps as we approach that 74.60 area. But until or unless this market confirms a bullish divergence in at least short-term momentum, further and possibly accelerated losses are expected straight away, and traders are advised to not underestimate the extent to which this market might now be vulnerable to further losses. Lastly, looking at the 10-year T-note market and reflecting this scare to the stock market and the macroeconomic condition, certainly as a result of the events in Japan. You can see the sharp continuation of this broader recovery from the February 9th low at 116.03. That, as we've discussed for a number of weeks now, we believe is a larger degree correction of the entire October through February sell-off. The market has cruised through, on basis the June contract has cruised through the 50% retracement of that sell-off, but on a weekly continuation chart basis, where reflecting the most active futures contract, you can see here that the market has just now reached the 121.18 area. That's the 38.2% retrace of the 128.01 to 117.22 decline October through February. But while this 121.5 area is considered a resistance candidate, clearly the trend is up on at least an intermediate term scale, and the market needs to confirm a bearish divergence in momentum needed to arrest this clear and present uptrend. And currently we think weakness below the 120, the figure area, an intraday corrective low from Monday, and a level below former 120.05 resistance considered new support. The market needs to fail below at least 120, the figure, to threaten this recovery and expose a more considerable relapse. In lieu of such weakness, at least such weakness below 120, further and possibly accelerated gains remain anticipated. Moving back to the June contract, you can see the 122.10 area is the 61.8% retrace of the October through February sell-off. And also from a yield perspective of the actual 10-year yield on a daily log close-only basis, you can see of the entire textbook 5-wave Elliott wave sequence up from that October 7th low at 238 up to 3.74% rate on February 8th. The 38.2% retrace of that entire rally in rates cuts across at a 3.15% yield. But here again, if that Fibonacci relationship or any support candidate is going to in fact hold as support in terms of yield or resistance in terms of price, we absolutely need the market to arrest this clear and present, at least intermediate term downtrend in order to stem this relapse in rates and define a more objective low and support, or in the case of prices, a more objective resistant high that we then can reconsider, from which we can reconsider a broader bearish policy. In lieu of such a confirmed bearish divergence in momentum, the trend in T-note prices in absolute fact is up and should not surprise by its continuance or even acceleration. In sum, a bullish policy remains advised in the 10-year T-note markets, with weakness below at least 120 even required to warrant moving back to a neutral sideline position. Please stay tuned to updates on these and other markets on our rjomrt.com website, and good luck with today's trading.